So this is where we're going to begin this morning. What we're seeing in the market after an initial steep drop in futures, the stock's now back in the green after that clarification. Allie McCartney of UBS Wealth Management and Leo Kelly of Verdance Capital Advisors join us now. Good morning to you both. Allie, I'll start with you. Whether it's the trade angst, whether it's the increase in coronavirus cases in a number of states and also hospitalizations, whether it's the data we've been getting out this morning and overnight, what is driving the market right now?
The market since basically quarantine has been driven by our fast and furious Fed, which has been followed by Federal Reserve support around the world that is both unprecedented in scope and extraordinarily targeted. There are also two other things which are driving the market and I think will continue to produce volatility, one of which was evidenced last night, which is continued conversations and tension and volatility around the election. China rhetoric is going to play a large part of that. Taxation will also play a large part of that. The other thing is simply the second wave. Now, obviously, we've seen both in this country and in Asia significant second waves, but that seems to not be affecting the market in the way in which a lot of us thought it would. And again, that just simply goes back to the Fed. When you look at the amount of stimulus, the amount of money, M1, money supply that's been put into this economy, in the last 3 months, our money supply year over year has grown 34%. There is a strong correlation between year-over-year growth in money supply and, not surprisingly, in multiples in valuation and in equity prices. And I think, this is really, again, fast and furious Fed is really tough to fight on a micro level.
Yeah, and certainly there's no denying what the Fed's policies have meant to this market. And along those lines, I want to get your thoughts on this topic, Leo, especially since the market is really, at least right now, pricing in a quick recovery to normalcy. The S&P has retraced, 75% of the losses in less than 3 months? How sustainable is that?
Well, as long as the pace of change continues to improve, then I think it's still sustainable. In other words, when we look at economic data, while it is not as good in any measure as it has been, it is improving consistently, and that pace of improvement is actually accelerating. More importantly, in the world of the science, we're seeing that improve dramatically. So when we look at whether it's vaccines or it's therapeutics, there's so much going into that solution all at one time, money, brain power, that is developing very, very quickly. And that gives hope that we're going to open up quicker and we're going to have a much faster recovery. Add to that the Fed, add to that the stimulus and all of the capital that's poured in the system. And it's not very surprising that we have a recovery. Now, in terms of valuations, obviously there are pockets of the market that have really shot up and are starting to reach extremes. There's some significant valuation gaps in the market between certain sectors and industries. And I think investors just have to be very smart and disciplined at this particular time. I think the biggest mistake an investor can make is trying to match the volume of news flow with the volume of activity in their portfolios. This is a point where you have to be smart. It's good to have a little cash on the sidelines, expect volatility, and be mindful of two things: your allocation, your targets, and what the valuation is in the market. Discipline is the call here, especially after a run this significant.
Yeah, Allie, how do you see this? I mean, how are you advising clients right now with markets at the levels they're at? Where are you suggesting they be invested, and what does a portfolio diversification look like right now?
I would have to agree with the comments made earlier. I think diversification and discipline are key. Stay invested. Again, the market is very well supported. Asset managers, a lot of hedge funds, still have a lot of money on the sidelines to continue this sort of buoy up of risk asset themes. I think you want to go to, again, the points that were made, to the laggers, to the place that have not experienced that run up. That's some values, some cyclicals. The UK is a very value-oriented market that has been sort of unfairly hit as a result of that. Long-term themes, the amount of money that has gone into in the IPO high yield market and just in the intellectual capital research market of a lot of long-term health themes is going to create, I think, a lot of upward movement, whether you do that through the public or the private markets to play oncology drugs or growth in genetic therapies. But I think long-term, don't be too cute, stay diversified. It's a great time for alternatives.
To that point, if I could,
and finally, Leo,
I was going to say to that very point, there's a lot of cash in the alternative markets, and private equity has an awful lot of cash. This move down and back up was so fast that there wasn't time to adjust the amount of money flowing into private equity. And what we've just had here for private equity is maybe the most astonishing stress test in history. And so if fresh cash is going into the private equity markets today, there is yield, there is opportunity in buyout, there's opportunity for this incredibly unique moment for private equity to discern the real strength of businesses and other financial assets that didn't exist prior to the COVID market. In fact, I think we were getting a little too laxed in some of that due diligence across the private equity market. Witness WeWork. Today, there's going to be a lot more discerning eye. So maybe not the high-flying, exciting market we had, but I think definitely a market where returns can be achieved back at traditional levels.
Yeah, okay, we're going to have to keep an eye on that. Thank you both for joining us, Ali and Leo, with the major averages in the green right now. Although off highs of the morning, the S&P is up about 0.75%. Carl?
All right. Yeah.